In this video, I'm going to program a trading strategy that the largest hedge funds in the world use. And that is, the hedge grid strategy. The main idea behind this strategy is that you don't need to be right about the direction of the market in order to profit from it. Many people consider it a holy grail of trading when used right. Like any trading strategy, this one has its pros and cons too. I will discuss them later in the video. Now, let me demonstrate the concept of this strategy. Firstly, let's create a grid on this chart. Each line of this grid represents a price level for opening and closing positions. At each of these price levels we are going to open one buy and one sell position. The initial positions are going to be opened on the first bar of the chart. So that would be right here. We are going to open buy and sell positions simultaneously. After that, we would wait for a price to reach one of the grid levels. And exactly that happens right at this point. Now, we would close our sell position and we would change the take profit of our buy position to break even. After that, we would open one new buy position and also one new sell position. I know that it can be difficult to understand it at this point, and that's why we're going to keep track of everything right here. Just to recap, we started with one buy and one sell position. Then we closed the sell position and opened two more positions. Thus, we currently have two buy positions, one sell position and one position closed with profit. The next contact with grid level happens right here. At this point we are going to close both of our buy positions, one of them in profit and one of them on break even. After that, we open two new positions. The next contact happens right here, and that results in closing two sell positions and opening two new positions. Also, we are going to change the take profit of our buy position to break even. I am going to do one more example for you, just to have a better grasp of this concept. The next contact happens here and therefore we close both of our buy positions, one in profit and one on break even. We also modify our sell position stop loss to break even, and after that open two new positions. Now I'm going to fast forward and add up the remaining trades. Just for the sake of easier explanation, let's say that the gap between each of the grid levels is 100 points. If we would have followed the same logic and eventually closed all the positions on the last bar, the gross profit would be 1800 points, and the gross loss would be 900 points. So that leaves us with a profit of 900 points. That's not that bad for a system that is that simple, right? Now that I have explained the theory behind this strategy, I'm gonna head to the MetaTrader 5 editor to create an expert advisor from it, so I can test it on real data. So, the expert advisor is completed. Let's test it. As you can see, it works exactly as I demonstrated before. I will leave it here for a bit, just so you can see it in action. The back test was conducted on the last 7 years of data, and here is the result. The main issue here is that widening gap between balance and equity line. This would eventually lead into a destructive drawdown and blowing the account. Fortunately, there is a simple fix for this. We will add a profit target for each cycle of trades. Once the profit target is reached, the expert advisor is going to close all open positions. This way we will be protected against unexpectedly blowing the account. So, let's go back to the editor and modify the code. The code is modified, so now it's time to check if it helped. And as we can see, it did. Now it does a relatively good job securing the profit and keeping the balance and equity line closer together. It is probably obvious, but I will mention it nonetheless. This is an extremely simplified version of this strategy. If I would wish to use this strategy for actual live trading, much more thinking and time would go into creating the software. Now, it's time to talk about pros and cons of this strategy. Let's start with the positives. The biggest advantage is that this strategy works extremely well in a sideways market, and is capable of maximizing the gains from a market move. The next advantage is that this strategy does not require any deep knowledge of the markets. Also, if automated, it does not require any supervision. Now, let's talk about the disadvantages of this strategy. I will start by saying that there is a reason why this strategy is used mostly by hedge funds. That is because it requires a lot of capital in order to make it effective. Also, it is extremely difficult to get the software right. A lot of math and probability goes into it, also portfolio management knowledge is needed. So, that's that. If we omit these reasons, the biggest disadvantage is that it does not work well in a trending markets and there is a high probability of running into a relatively big drawdown. So that's it for this video. Don't forget to share your view on this strategy down below in the comments. Thank you very much for watching, and take care. Also, if you would happen to be interested in an expert advisor that actually works and can grow your account responsibly, check the link below a video. It's the one you are seeing right now.